Welcome to Griffonomics. Today we're doing something a little different. Usually when we talk about, high-tech explosions, AI revolutions, massive stock potential, we're looking at companies in Silicon Valley.
Slick logos and
Oh,
CEOs and hoodies, sure.
exactly. But today you've brought me a pump company. I'm looking at this list and I see valves, meters, dispensing equipment. It feels like we should be wearing hard hats for this one.
Well, you can put the hard hat away, or actually maybe keep it, but trade the wrench for a microscope. Because if you think IDEX Corporation is just about plumbing, you are missing one of the most fascinating identity shifts in the entire market right now.
Okay, I'm listening. But you have to convince me why a company that makes water meters for cities is relevant to anyone interested in the future of tech.
Think of it as a disguise. On the surface, IDEX looks like a standard, reliable, maybe even a little boring industrial conglomerate.
Mm-hmm.
But we've been tearing apart their Q4 2025 earnings report, and the story inside is completely different.
Okay.
They're effectively shedding their skin.
Shedding their skin.
They are pivoting rapidly from a general industrial manufacturer to a high-growth infrastructure provider for compute.
Compute, as in the backbone of AI and data centers.
Exactly. The headline of our deep dive today is literally From Pumps to Processors. We need to figure out how a company known for fire trucks is suddenly dominating the semiconductor ecosystem.
And here's the mystery, right? They just beat their earnings estimates, they crushed their revenue targets, and yet the market barely shrugged.
The stock actually dipped a little.
It did. And that disconnect between what the company's actually doing and what the market thinks it's doing, that's usually where the opportunity hides.
That's the thesis.
All right, let's peel back the layers. You mentioned this pivot. I saw that management used a phrase that sounded very dramatic, a strategic inflection point.
Which is corporate speak for no turning back.
But where's the proof? Because, every company claims to be an AI play right now.
Oh, absolutely.
Even my toaster probably claims to have a neural network.
The proof is in the backlog. The backlog is basically the orders they have signed but haven't delivered yet. It's like a crystal ball for future revenue. And management revealed that just under half of their year-over-year backlog growth is coming from one specific place.
Let me guess. Not water treatment.
Direct data center applications.
Wow. That is massive. So nearly 50% of their future growth is tied directly to the cloud.
Correct. And to see how that translates to real numbers right now, you have to look at their business segments. IDEX is split into three main buckets, but the star of the show, it's the Health and Science Technology segment, or HST.
I saw the number for HST and I honestly thought it was a typo. In Q4 2025, they posted, what was it?
34% organic order growth.
34%.
No typo.
In the industrial world, isn't like 5% considered a good year?
5% is a champagne-popping year in industrials. 34% is hyper-growth. It's software numbers.
So what are they selling in HST? When I hear health and science, I think of stethoscopes or, test tubes.
And that's the legacy perception. And sure, they do medical devices. But the engine driving that 34% growth isn't medicine. It's semiconductors.
Yes.
It's the stuff that makes the chips. They are providing what they call consumables for memory production.
Hang on, consumables? Like printer ink?
That is a great analogy.
Mm-hmm.
In semiconductor manufacturing, you have these massive machines that print the circuits. But those machines need constant streams of incredibly pure fluids, filters, specific materials.
Stuff that gets used up.
Stuff that gets used up and needs to be replaced. It's recurring revenue.
So they aren't just selling the machine once, they're selling the ink forever.
Exactly. And it gets more technical. They're providing very critical componentry for lithography.
Lithography. Okay, I hear that word thrown around a lot with ASML and the chip wars. Break it down for me. What is IDEX actually doing there?
Well, lithography is basically using light to print patterns on silicon that are so small you can't see them with a microscope. It requires insane precision. We're talking about controlling fluids and optics at a level where a single speck of dust can ruin $1 million batch of chips. IDEX creates the valves, the pumps, the manifolds that handle these fluids without contaminating them.
So if the lithography machine is the artist, IDEX is the one handing them the brush and the paint.
And making sure the paint is perfect.
Yeah.
They've bolstered this by acquiring companies like Mott and forming a unit called Material Science Solutions. They're building a toolkit that the chip makers, well, they literally cannot function without.
So that explains the growth. They've hitched their wagon to the semiconductor supercycle.
They are decoupling their destiny from the general economy. Usually if GDP goes down, an industrial company goes down. But if you are essential to the AI build-out, you don't care about GDP. You care about GPU demand.
Which brings us to the other side of this. We've talked about making the chips. Let's talk about running them, because the report mentions a data center moat.
This is my favorite part of the whole story.
I see units listed here like performance pneumatics and air-tech valves. Again, these sound like things I'd find in a mechanic's garage. How does that fit into a server farm?
It all comes down to heat. You know that AI chips, those massive NVIDIA GPUs run hot.
Incredibly hot. I've read you could fry an egg on them if they aren't cooled properly.
Precisely. And for the last 20 years, data centers have just blown cold air on them. Fans, air conditioning. But the new AI chips are so powerful and so dense that air just doesn't work anymore.
It's not efficient enough.
Not even close. You can't take the heat away fast enough, so they have to use liquid.
Liquid cooling.
Right. They are piping coolant directly to the chip plates or even immersing the whole server in fluid. Now, just imagine the plumbing required for that.
It has to be perfect, because if a pipe leaks...
You destroy a $100,000 rack of electronics. You cannot have leaks. You need quick disconnect couplings that seal instantly. You need precision metering to ensure the flow rate is exactly right so the chip doesn't overheat.
And who makes the best precision, leak-proof valves in the world?
The guys who've been doing it for decades for the chemical and medical industries.
IDEX.
That's the pick and shovel play.
Exactly. Everyone is rushing to find the AI model, the chatbot. IDEX is selling the shovels, or in this case, the plumbing that keeps the gold mine from burning down.
It makes sense why they list data centers as a phase 3 growth pillar now. It's not a side project.
It's the core strategy. But we have to ground this. If everything is going so well, why did the stock slide? We need to look at the financials.
Right, the scorecard for Q4, they beat the numbers. EPS came in at $2.10, beating the $2.04 estimate.
A record EPS.
And revenue was $899 million, which also beat expectations. So record profits, revenue beat, and the stock went down 1.34%. It feels unfair.
It's the classic beat and slide. The market is looking at two things: the quality of the earnings and the guidance for the future.
Okay, well, let's talk quality first, because there is one number here that stood out to me as a non-accountant. Free cash flow conversion of 121%.
That is a monster number. Explain that to me. How can you have more than 100% conversion?
So net income is an accounting number, right? It includes non-cash things like depreciation. Free cash flow is the actual cash entering the bank account. 121% conversion means that for every dollar of profit they claimed on paper, they actually generated $1.21 in real cash.
So the quality of the earnings is incredibly high. It's not accounting magic. It's real money.
It's the gold standard. They generated $680 million in operating cash flow, and they're using it. They spent $73 million just on share repurchases in the quarter.
Buying back their own stock. That's usually a signal that management thinks the price is too low, right?
It's the ultimate vote of confidence. And speaking of confidence, we have to mention the new CFO, Sean M. Gillen. He just took over on January 5th.
Coming from Goldman Sachs originally, wasn't he?
Yes. And you don't hire a former Goldman banker to just sit on your hands. You hire him to allocate capital to figure out where to deploy all that cash to grow the fastest.
Okay, so they have the cash, they have the growth engine. But I want to know how they're squeezing out these profits. Because you mentioned they have a very specific operating model.
The 80-20 rule.
I've heard of this, the Pareto principle.
Right, the idea that 80% of your outcomes come from 20% of your causes. In business, it usually means 80% of your profit comes from just 20% of your customers.
So what does IDEX do with that info?
Most companies just accept it. IDEX weaponizes it. They analyze their data, find that top 20% of customers driving the profit, and then they treat them like royalty. They overserve them.
And the other 80%, the trivial many.
Do they just ignore them?
Worse, they fix them or they fire them.
They fire customers. Really. If a customer is ordering small batches of complex, low-margin parts that clog up the factory floor, IDEX will just raise the price. If the customer leaves, fine. IDEX actually wants them to leave.
Because it frees up capacity for the high-profit work.
Exactly. It sounds ruthless.
It does.
But it's discipline. And it works. Look at the margins. Their adjusted EBITDA margin expanded 40 basis points to 26.8%.
And 40 basis points is roughly 0.5%.
Right. And they did that even though their total sales growth was pretty modest. They're literally making more money on every dollar of sales just by simplifying the business.
And I assume they apply this to the companies they buy, like Microlam.
Absolutely. They bought Microlam for about $90 million to boost their optics game. They bring it in, apply the 80-20 filter, Cut out the noise, and suddenly that acquisition is printing money.
Okay, I'm sold on the strategy, but we promised a balanced view. We have to talk about the anchor, because there's a reason the guidance for next year was so conservative.
The other, IDEX, the parts that aren't involved in AI.
We have the fluid and metering segment, or FMT, and fire and safety, FSTP. Let's start with fluid and metering.
It's a mixed bag. Municipal water is doing well. Cities always need to fix pipes. That's growing mid-single digits. But the industrial side, chemicals, agriculture, energy.
The report mentioned softness and mobility custody transfer. I stared at that phrase for 5 minutes. What on earth is mobility custody transfer?
It sounds like a prison transport, doesn't it?
It really does.
It's actually very simple. Think about a fuel truck transferring gasoline to a gas station, or a refinery pumping oil into a tanker. Custody transfer is that moment the product moves from one owner to another. You need an incredibly accurate meter to measure that, because money is changing hands.
So it's the cash register of the energy world.
Exactly.
Yeah.
And right now, that business is soft. The energy sector isn't spending much on new meters.
And then there's fire and safety. This is the one that looked ugly to me. A 5% organic sales decline.
It's tough. They had record sales in 2024, so it's a hard comparison. But the issue is global. They are seeing funding headwinds in Europe and Asia.
Meaning governments don't have the budget for new fire trucks.
Exactly, or they are delaying the purchases. It's not that fires have stopped happening, but the municipal budgets are tight.
So we have this dynamic situation. Half the company is strapped to a rocket, HST, and the other half is dragging an anchor.
And that tension right there explains the 2026 outlook. This is the part that spooked investors.
The guidance. For the full year 2026, they are projecting only 1 to 2% organic growth.
1 to 2%.
That feels amazingly low. We just spent 10 minutes talking about 34% growth in HST. How does that average out to 1%?
It's the weighted math. HST is a big chunk, but the industrial and fire segments are still massive. If they are flat or down, they cancel out a lot of those HST gains.
Do you think management is being honest here? Or is there some strategy in setting the bar this low?
I smell sandbagging.
Sandbagging.
Look, you have a new CFO. You have an uncertain global economy. Why would you come out and promise 5% growth and risk missing it? It is so much smarter to promise 1%, knowing you have this AI engine in your back pocket.
So they set a bar they can easily hop over?
Correct. They guide for $8.15 to $8.35 in earnings per share. Wall Street wanted $8.31, so they essentially told them, hey, we might come in a little light.
But if that AI segment keeps growing at 30% plus, they're going to blow that number out of the water.
That is my read on it. They are protecting the portfolio. Risk defined, as they say.
So bringing it all together, we have a company that is fundamentally changing what it does, but is priced like it's still doing the old thing. Where do you land on the verdict?
For me, it is a definitive BUI.
You aren't worried about the fire segment dragging it down?
No, because the mix is shifting. Every single quarter, HST becomes a larger percentage of the total revenue. They are re-rating their backlog toward the secular megatrends.
Secular megatrend. That means a trend that happens regardless of the economy.
Right, exactly. People might stop buying tractors, which is cyclical, but they aren't going to stop building the internet. That's secular. IDEX is moving from the tractor business to the internet business.
Like they still have the safety net.
Right. Even if AI slows down for a month, cities still need water, fires still need to be put out. It's a portfolio-protected approach. You get the upside of a tech stock with the floor of an industrial utility.
That's a rare combination. Usually you have to choose between high growth and high safety.
And that is why the valuation is so interesting.
Here is the thought I want to leave our listeners with today. We always look for mispriced assets. Is IEX actually a technology infrastructure company currently disguised by a legacy industrial valuation?
That's the multi-billion-dollar question. Right now, the market looks at them and sees pumps. One day, the market might wake up, look at those HST numbers, and see compute infrastructure.
And if that re-rating happens?
The stock price will not stay where it is. Multiples for tech companies are double what they are for industrials.
The disguise is wearing thin. The numbers are leaking out.
And when the market fully realizes it, the window of opportunity might close.
Well, we'll be watching those conservative 2026 targets very closely. My guess is they beat them.
I would take that bet.
Thanks for joining us on this deep dive into the plumbing of the AI revolution. It turns out valves can be exciting.
Keep looking beneath the surface.
We'll see you next time.